is your net profit. So that is the normal perception for accountants, but there is much more than this in accounting. So accounting is basically maintaining the records. So we will look at the definition. So, but we just need to clear the accounting, the fundamentals. So who needs accounting? Who need to do it? Everybody need to do. But mostly is the physical job is the the accountants, right? But who need to do? Every business need to do it. Even though you are a not for profit organization, you are a profit organization, you are a government organization, you are a startup, everybody need to do their accounting, right? To know how much is your income, how much is your expense, how much assets you have. So do you know in your family business how much is the value of assets you have? You don't need to tell us, but just answer yourself. Do you know how many millions of dollars you have now? I don't think small, huh? I always big, I always think big. So you will not see me using 100,000. I'll always use millions and billions of dollars, okay? And also in dollars, not in Myanmar chat. So you need to know that, so that you know how much you have, where you can invest, and how you are going, what is the return on your investments, right? And why do we need it? As we know, for understanding your profit and loss, understanding the returns, how much money you are earning, are you earning enough or not, right? If your business is earning less, if you have invested, let's say $1 million in any business, and that business is giving you $10,000 a month income, will you be happy? No, right? Why? How you say no? How you compare? How much you want? So means you need to have a target, right? So you may have a target based on, let's say, bank interest. You may target based on other business opportunities, or you may target based on another investment profile that you want to use, right? So you always want to compare your returns, what you are getting, compared to your targets. So, but how will you calculate how much is your actual returns? So actual return is very difficult to measure, and is not, it's very subjective. It depends on what are you looking at. Are you looking at cash flow, or you're looking at accounting profit, or you're looking at value? There are three different concepts of how much money we are getting. You may be investing in a real estate business where you're not getting much rent, but your value of your building and land is increasing very significantly, right? And there is another investment next to it which will give you a lot of rental income, but at the end of the day your land and building value is actually dropping. So which one you will prefer? It depends on, there's no right answer, it depends on your objective. Do you want a regular cash income, or you want value increase? Correct? So it depends on the business objective. What are the business objective? Okay? And who are the target users? So everybody is a target user. Everybody need to understand it, be it from the CEO, the business owner, even the staff of the company, the government need to know how much you are earning, right? So that they can collect the right tax from you. I'm sure not everybody is submitting the right tax, because you have 2 set or 3 set of the financial statements, right? In your real life, that's real life, right? That's Myanmar, or even in where I come from, India, we never submit our 100% tax. We submit only 20% of income to the government, and we pay the tax based on that. But government want to know, right? So government finds a way that how to know that how much income you are earning. So government is also trying to understand what is your income levels. Staff need to know, will you be able to pay salary next month or not? Correct? So they also need to have a financial statements. If you are a startup, maybe somebody who is a high profile job, let's say somebody who is established job person, who gonna leave his job and come to your company, he need to know how long you will be able to pay the salary. So how he will know? He will look at your financial statements, right? He cannot look at your bank statement. He will not ask you, because if he asks you, yeah, sure, we will pay, don't worry. And then for 1 year, you don't pay the salary. But if he has access to your financial statements, he can know. There are indicators that the company is sound enough or not. When you are investing money into the business as an investor, you want to know the company is sound or not. the money you are put into the company is worthwhile or not. Correct? So from the investor perspective, staff, creditor, whoever is selling you anything for credit, he also need to know this company can pay money on time or not. Correct? So there are a lot of indicators that we will learn today, how to understand that company is solid or not. Okay, so this week we are going to be focusing only up to this part. Next week we'll learn more advanced topics. Okay, so what is financial accounting? So financial accounting, you can assume, is like a process. Okay, so the process starts from recording the financial transactions. So what is a financial transaction?
How much you gain, how much you get, and how much you.
So that is correct definition, but financial transaction means anything, any business transaction that you do which involves money. So you may be paying money physically, or you may not be paying money, but you may have to pay in future. So anything which relates money is financial transaction. Is it okay? Very hypothetical example. Huh? If you love your girlfriend, is it a financial transaction? No, right? You are just loving. There is no money involved. Yeah, you have gifts, but that is not the transaction, right? Correct? So that is not a financial transaction. But if you give a gift to your girlfriend, is that a financial transaction? That is a financial transaction because it involves money or something which can be measured by money. Okay? So any transaction when a business does which can be measured by money, it is a financial transaction. So it needs to be measurable. So love, emotions, they are not measurable. If let's say you are creating a brand, right? You have a business. For example, let's say Apple. Apple is now worth $1 billion in their brand value. Okay, but if you look at in their balance sheet, there is no money, there is no asset called Apple brand value. Why? Because they are creating it. They are just making it. They didn't buy it from anybody, right? So that becomes their brand value. So creating a brand is not a financial transaction, but buying a brand, paying money for a brand, it is a financial transaction because you are paying money. You are measuring it by some way somehow, right? If you have your own brand, you cannot measure your own brand, or you cannot record, you are not paying to anybody, correct? But if somebody else is buying your brand, it is a financial transaction. So we always record only financial transaction, we don't record non-financial transactions. So when you hire a staff, correct, the staff value is much more than what you pay to them, correct? The staff, the salary is, you are paying them, maybe let's say you hire $1,000, but you know that the skills are valued more than $1,000, correct? But so are you recording $1,000 or more than $1,000? You are not recording for the skills, you are recording only for the money that you are paying to them, correct? And after you have recorded these financial transactions, only financial transactions, the next job is to organize the transactions by account for business decisions. So how you record, how you organize your transactions? So the transactions can be recognized, for example, revenue segmentation, where you are getting your money from. Who are your customers? Are you getting money from Japan, from Australia, from Singapore, from where are your customers coming from, right? So the segmentation means who are your customers, different type of customers. Okay, so we're going to be learning revenue segmentation later. What are the more details in revenue, how we segment the revenue. But the business earns money from different sources. So every different customer who is paying you, not every customer is gonna pay you more money, right? They may be paying you different values. For example, airlines. Somebody is traveling in business class. Somebody is traveling in the economy class. So it's the same plane, but the airline is getting money from two different sources. One who is flying in the business class, one who is flying in the economy class. But if they don't segregate, they have no idea. At the end of the year, was business class successful or not? Correct? If nobody flies in the business segment, so what they should do? They should kick off the business class and put everywhere only economy, because nobody is flying business, right? So business segmentation is very important to understand where your money is coming from and where you need to focus to make it even more, even better. What type of customers paying you money and what type of customers can pay you more money, correct? And also the segment cost center means profitability. Your company may have different type of products. Your company may have different departments. So you want to know what type of products are giving me better profit, or what type of departments are giving me, what type of business are giving me major profits, right? Not just only that, okay, if I have 10 businesses, I continue to run all 10 because I don't know which one is profitable. But overall, I'm making profit. Okay, so let's say there are 10 businesses, two businesses are making $1 million each, so you make 2 million. Other business are losing 100,000 each. So in the net you still make money, right? But if you don't segregate, you have no idea. If you segregate, then you know, okay, we keep these two and we kick out the other 8, so we can save. So our net profit will be 2 million rather than 1.2 million, right? So we want to segment the revenue. So how you will know that? By segregating the transactions into each profit center for each segment of revenue, so that we can understand the business position. What is our existing business position? And finally, we group all these transactions into financial statements. So the financial statements includes your profit and loss, your balance sheet, and your cash flow. So there are three major financial statements that we use in our business. One is profit and loss statement, one is balance sheet, and one is cash flow. We're gonna look at the sample template for that. And a periodic interval is usually we do the grouping at least once in a year for tax purposes. But business can generate their profit and loss statement every month as well. You can do it even every week if you have a lot of staff and they can generate it if you're using systems. But if you're using manual accounting, you cannot do it every week or every month. It's very difficult, right? So it's mostly we do it every month or once in a quarter or once in a year. Okay. So the accounting works on a double entry system, like human. We work on two legs, right? If we have only one leg, we buy another one, but we have to have a balance. So the accounting also works in the same way. It has to have a balance. Two transactions, two leg of transactions. Okay. So two double entry system. So every transaction has two sides. Even in a real life transaction, if you are giving something, you are getting something back, correct? Which is measured in value, which is measured in terms of money. When you are selling something, what are you getting back? And what are you giving? Your product or your services, correct? Which is measured at the same value, correct? In olden days, when we were doing the transactions, when there was no money, we used to barter, correct? You take my laptop, I take your laptop, or you take my rice, I take your meat, correct? And the value was like this, same, we work in the same way, right? We sell something and we get something back. So accounting works in two ways. One is something we going out, something is coming in. Either we receiving something physically or right, or we can call it our gain, right? Whatever we are making, or in return of giving something back. So it can again be physical or it can be only a right. So we have two transactions. One is we are giving and one is we are getting back. So we need to record both sides of transaction at the same time. Otherwise your accounting will stumble, okay, if you have only one leg. For example, sales, either we can sell in cash or we can sell in credit. Okay, how we are going to record, we will look at the next slide, but at the time we just understand there are two types of transactions. What we give is our goods and what we get is cash or right to receive a cash in the future. Hiring a staff, what we get? Services from their staff, which is valued equal to the salary that we are paying, correct? In real life, the staff is giving much more value to the business, more than what you are paying to the staff, right? But you cannot record that extra. You can record only up to the level, up to the salary that you are paying. Okay. So we to record the transaction, we use something called T account. So the T account means we are it's like a T one account. So which we where we record one side debit, one side is credit. So you can use debit side, credit here, debit there, or debit here, credit there. It doesn't matter. What matters is that both sides need to be same, because we are using two side of transaction, right? So how we use it? We every financial transaction has two sides. Debit means something receiving, mostly is means coming in. Whatever comes in or whatever we get, normally we record as debit, or we expense, we lose. Whatever we give back to anybody, we normally record as credit. Okay, in accounting term, credit means your liability or your gain, and debit means your assets, whatever is your right to receive in the future. Okay, so there are some fundamental rules which you need to know when you are recording the transactions. So the rule one is whatever coming in need to be on the debit side, and whatever is going out need to be on credit side. So in the previous example, we look at sales in cash. So what went out from our organization in sales? Your goods, correct? So what will be the accounting? If let's say we want to record accounting transaction, what will you record? How will you record it? What will be the credit? Sales, right? Your sales or your goods, that particular good will be credit. And what will be the debit? What is coming in? Cash is coming in, right? So the accounting entry, so we call this one financial transaction, one accounting transaction. These two sides will form of one transaction, right? So debit, cash, credit, either sale, or you can call it that goods name, whatever you are selling, or services. You can say consulting, you can say anything that you are selling. Okay, so that means this is one transaction. The second rule in accounting is debit the receiver, means whoever is receiving the money from your side, he should be debit, and credit the giver, whoever gives the money to us will be credited. So if let's say you sell something on credit, now the person is paying you the money, correct? So in this case, what is happening? Who is giving the money? The customer, correct? So you will receive, you will debit, you will credit the customer, and what you are getting back? You're getting in money. So you are using rule 1 and rule 2 together. So it's not necessary that one transaction will follow only one rule. The one transaction can be affected by two different rules. So here, if you receive money from your customers, you are basically receiving the money from credit the giver, means whoever is giving the money will be credited. But what will be the debit then? That is not written in this rule, right? That is written in this rule. Debit what comes in. Okay, so whatever is coming in means cash is coming in. So the accounting transaction will become debit, cash, credit the person who gives the money. Okay, rule 3 is debit all your expenses. Whatever is your expense, whatever you spent is your debit side, and whatever is your income, you may be selling something, right? So that is your credit side. Okay, the last rule number 4 is debit all your assets, whatever is you hold. If let's say you buy a laptop, you buy a house, you buy a car, it always will be debited, because you are getting in something, right? And in return you are paying something, you are paying money, so that will be credited. So these all the accounting transactions, the whole accounting transaction will follow only these 4 rules. These are like foundation. Okay, so you can either take a picture or you can note it down so that you remember. At the end of this, we will do a little exercise to understand these rules better.
I have a question.
Hmm.
I don't really understand rule number 3.
Debit expense and credit income.
Yeah, because you said debit is what comes in, And expense is what you give. So why is debit the expense?
Okay, debit expense means that's why it's a rule, because there's rules are rules. So debit expense means, expense is what? What is your expense?
Salary?
Yeah, salary, right? So you are giving salary. So but you are not giving salary, you are giving cash. Correct? So it will follow rule number one. Cash going out. But what is coming in? Nothing. Your only services are coming in. But you cannot record services, right? Those services are your expense. You are hiring a consultant to do a job for you. So that is an expense for you, right? So that expense will be debited. So debit the expense and credit the whatever is going out. So if you are paying in cash, you are paying in credit, that will be going out. So expenses will always be debited. Means you are using the money for your business. So it can be rent, it can be salaries, it can be printing and stationery. So you can say a contradicting rule. Let's say you are buying a stationery from outside, right? So what is coming in? Stationery. So that will follow the rules, right? Debit what comes in, or it can follow the rule debit expenses. So stationery, when you buy a pen or pencil from the market, it's an expense for you. But you can follow rule number one. What is coming in? Pen is coming in. So you debit pen, credit money out. But pen is what you are going to do with the pen. You're going to use in your business, right? And that you can record either as an asset or as an expense. So what you will record as an expense and what you will record as an asset depends on the business, depends on the size of business. Some businesses are so large that even a value, even a item of, let's say, a chair, it doesn't really cost them anything. This chair maybe cost 50,000 charge, for them is nothing. So they don't want to record every single thing that we buy from the market as an asset. Okay, though they define the assets. What is an asset? Usually by accounting standards, asset means whatever can last you for more than a year and has a value, economic future use value. So if something you are buying, let's say in that case you can rule out this chair will last for more than 2 years for sure, and you can continue to use this chair for that time, right? So ideally this chair should be an asset. But business can decide, I don't want to record the chair as an asset anymore because it's too small in my overall balance sheet. So I will record this as an expense. Whenever I buy it, put it into expense and finish it. Okay. So the why we record expense and why we record the asset, because if you record something as an expense, you are charging it to you are charging a concept, something called depreciation. We will learn that later on. Don't mix it together. Okay. So everybody now clear on these four rules? Okay, good. So the process of accounting is this, four steps. First is we record the transactions. Okay, we record the transaction into journals. So it's like a diary. You can record in a diary whatever is happening. You record both sides of the transaction in your diary, like a daily journal. Okay, like a logbook. So all the cash, sale, purchase, whatever you do in your daily transaction, you just need to record in your journals. Okay, and then in chronological order, means as they happen. Not that okay, tomorrow transaction is coming first and today transaction will go later on. It's not like this. It has to have a time series. Whenever you are spending, it need to be recorded in the exact same order. Otherwise you may mess up your books of accounts. Okay, it usually happens when you are recording all your, let's say, 1 week transaction at one time. So you may record whatever happened has on this Friday first and whatever happened on the previous Monday first later. In this case, you may have problems with your accounts. It will not show you the right balances. So chronological order is very important. It need to be recorded in a day by day manner. Exact sequence. Sequence is important. Then we draw something called general ledger. Okay. The general ledger shows the journal by account. So here in this first case, we record in a logbook all in one account, but we don't segregate. we have not yet segregated the transactions. So we don't know how much total salary we paid, how much total rent we paid, how much total money we spent on printing, how much money we spent on traveling, how much money we spent on food. So what we do is we create some buckets like containers, small containers, right? To segregate all our expenses into the containers, like-minded containers, right? All red come in red, all blue come in blue. So all salaries go into one account, all the rents come into one account, all the printing stationery come in one, all our assets come in one, all our buildings come into one, all our liabilities come into one, all sale go at one place. In the bigger container like sale, you can have small containers, by customer, by product. So you can record the sale into different small further details, further segments. But segregation is very important. The general ledger works for segregation, segregating the similar transactions into the same way. Okay, and then finally then the third step is we draw a trial balance. So the trial balance is nothing, it's just a summary of all your general ledgers. So what trial balance is doing is record all your transactions. You created all the buckets, so it will create a summary. Just list out total salary how much, total rent how much, total cash how much, total sale how much, whatever it is, and then it will tally up together. So the total of trial balance will always be equal. So trial balance will have two sides. One something with a debit side, one something with a credit side. Or you can solve it, some will be in minus, some will be in plus. So the total of trial balance will always be zero. It's a checksum. Just to make sure your accounting is correct. If it's not zero, means your accounting is not correct. Something did something wrong. Someone did something wrong. So if that happens, then a further investigation normally goes in to see where it went wrong. Okay. And then the last step is to draw financial statements from our trial balance. Okay. The trial balance will have assets, will have liabilities, will have income, will have expense, all four type of transaction into one. And then finally we segregate into different statements we call financial statements. So financial statements are three. One is profit and loss statement, one is balance sheet, and one is cash flow statement. So what what profit and loss statement tell us? What does profit and loss statement tell us?
It tells us whether your business is making money.
Yeah. Where how much money you are making, how much money you are spending. And what does the balance sheet tell us?
Your assets.
Your assets and liabilities. How much you have and how much you own somebody, right? How much you own and how much you owe. Okay, so this is an example of a journal. So how a journal look like? So the journal will have four columns. One is date. So it's gonna have like, okay, 1st of January, 2nd of January, 15th of January, 31st of January. Then we'll have accounts. What accounts are getting affected? So in the first transaction, what is happening? What are we doing in the first transaction?
Buying material to build products.
Yes. So you are buying a material, right? It's already written there, material to build products. Correct? So what you are doing here is you are buying some materials on credit. Correct? Because you are not crediting cash. So means you are not paying cash. You are just crediting to payables. Means maybe a supplier. Correct? And the second is you are doing a advertising expense, right? You are doing some advertising in somewhere online. And then what is the third transaction? Third transaction is selling on credit, right? So you can already tell is it on credit or cash, because it's debiting receivable, means you are not getting the cash immediately, right? So you are selling on credit. And the third is you are paying salaries, correct? So this is it's very simple, correct? Now everybody is clear on journal. So once you draw up this journal, we will segregate the transaction into journal ledgers. So here's an example of few journal ledgers. So we have cash on hand, right? So we have two sides. You can see one is debit and one is credit side, correct? This is debit side and this is credit side. So all the transactions which will happen on any day, if it's hitting debit side, let's say inventory is debit, right? And payable is credit. So we will in our journal inventory will be debited and payables will be credited. Whenever we pay to the supplier, we will debit them because the cash is going to be credited, right? So cash is going to be credited and debit will be your account payable. We just put into the buckets, okay, and then we see what is plus or what is minus. So you can assume debit as plus, credit as minus, and you will total it up to see what is the balance. So here is the balance. At the end of the day, you can say, okay, balance. What is the balance? Some accounts, some general ledgers by default have debit balance. Some general ledgers by default have credit balance only. But there are exceptions. You can have a credit balance of cash. Can you have a credit cash? Can you have a credit balance in cash on a cash in hand? What will be the meaning of a credit balance in cash in hand? When you debit, what do you debit the cash? When you debit the cash, when you receive it, right? And when you credit the cash, when it goes out from your pocket. So can you have more credits than your debits? How? You are printing money. Means you are receiving, let's say, $100. Can you pay 120? Cannot, right? So cash account will cannot have a credit balance, correct? Unless you are printing money. If you are printing money, then it's okay. You can have a credit balance. But if you are not printing money, you cannot have a credit balance, correct? So some transactions by default will have a debit balance. Means whatever you have assets, you cannot pay more than what you have, right? And creditors will normally have a credit balance. Suppliers, they owe you. Let's say you buy from some outside supplier for anything for $1,000. Will you pay them 1,100? No, right? You will always pay either 1,000 or lower than 1,000. Correct? If I am there, I would pay lower than 1,000. I will ask for discount, not extra. I will not pay more. So suppliers will always be credit. Your your customers will always be debit balance. Your cash will be debit balance. Correct? Your expenses normally will be a debit balance. Your income will always be a credit balance. So there are certain standards by default because of their nature. But you can have exceptions. So this is how the transaction work, and then finally you will have a trial balance. It's just noting out the balances in each account. So cash, how much is the balance left? Normally will be debit. Sub receivables, how much is that balance? Means how much our customers owe us. Sales, how much sales we did. So it will be a credit side. Payables will be always on credit side, right? Because we owe them money. Then you have cost of goods sold and inventory. So these are the total balance, and then we make a total. So make sure these two totals are exactly same. If this is different, if one is 17,000, another is 17,500, then your accounting is not correct. Something is going wrong. Okay, maybe you missed some transaction, or maybe you missed a total somewhere. Maybe you didn't do a totaling properly. Maybe your calculator was wrong, right? But nowadays, in today modern world, because all the accounting is done by softwares, all there are online cloud softwares, so you don't need to worry about it, because they will not allow you to record a transaction which is not going to be tally together. So this problem is very less nowadays. The trial balance always tally. You may record in wrong heads, but the total will always be tally. Okay. So then after we do the trial balance, the fourth step was to draw financial statements. Okay. So financial statements is like a movie, or you can call it a snapshot. So there are three financial statements that gives you different views. So one is the balance sheet, which gives you a snapshot. So snapshot means still, the still picture. It just gives you the current position. how much money you own, how much money you owe. And the profit and loss statement will is like a movie. It will tell you during the year what happened. So that is why if you notice any financial statement, you can list out any public company financial statements. You will always see balance sheet is always on a particular date. The balance sheet is never for 2017-18. So now the government is changing financial year for 1920, right? So when at the end of 2020, you're gonna make a balance sheet. So balance sheet is not for 1920. Balance sheet will be always as at a certain particular date. So balance sheet is always on one date. It is never for a financial year, never for 6 months, not for quarter, never. It will always tell you something at one particular date. And profit and loss statement is for a period. It can be for 1 year, it can be for 6 months, it can be for 3 months, it can be for one day. So income is like a movie. It will tell you during this period of 1 year what was our income, what was our expense, and how much was our profit. Okay. And cash flow is like your wallet. How much money do you really have in your pocket as of now? Okay. So in your financial statements, you may be making loss, but you may have cash in your pocket. Because, so what can be the scenario? Can you give me anything? Can you think of any scenario where your business is actually losing money, but you still have money in the cash in your pocket
So you have debt.
because you are borrowing the money, right? Payables, or you are not paying money to your suppliers, but you have expenses, correct? So you may have expenses, or you may be borrowing the money. That is the story with all the startups nowadays. They don't make money, but they have money, right? Where they get the money? Either they borrow, means from the payables, or they steal, means coming from the investors. Sorry. Okay. No, I don't mean to offend you, na. I'm just making a reference to WeWork. You know what happened to WeWork, right? Yeah. So that's why I say they are stealing the money. And that money is not also going from the investors ultimately. That money is going from the pockets of your guys again, because you have invested something in the stock exchange. Whenever they go for IPO, the money goes from the public, never go from the investor. Investor is already out. Okay, so the basic accounting equation, there's only one accounting equation in accounting, only one equation. Unlike mathematics, you have parabola or other things in engineering, but it's only one here. Assets are always equal to your liabilities plus shareholders equity. Okay, that is the basic definition. Assets will always be equal to your total liabilities, whatever you own to somebody else, or whatever money you have put into your balance sheet. So the balance sheet is made up of three components. One is the asset, one is owner's equity, and liabilities. Okay, so this segment, it can be larger for owner's equity or can be larger for liabilities, but assets will always be the same. So what does it tell you? It tells you how you are funding your assets, where the money is coming from to buy the assets. It can come from your own pocket, means owner's equity, or it can be borrowed from outside. It can come from debt, it can be from your suppliers, it can be from anywhere else. So total is liabilities. Okay, so that is the basic definition in accounting, and everything follows it. Okay, sorry. So the extended definition of accounting is, because we have one something called, so here in this balance sheet we are not recording sales or income. So this is something called extended definition. So extended definition is owner's equity can further be divided into your original capital, your paid in capital, means the money that you started the business with, and net income, whatever you have been earning. So if from your income you pay any dividend, means you withdraw money from your business, that is minus, the rest will go back to your owner's equity. Okay, so the owner's equity net income will take care of your revenue, your cost, and everything else. So this is how the profit and loss statement and balance sheet are merged, or you can say are matched together. Okay. So balance sheet is the ultimate document. Profit and loss statement is one step prior to balance sheet. To arrive at the balance sheet, you need to make an income statement to see what is your income and expenses and total income. If you have taken money from your income, means the dividends, that also you can minus, and the balance will go to your retained earnings. Okay, clear? So now you can draw the balance sheet. Okay, we will do a bit of exercise. So this is an example of how normally a income statements look like. So normally you have a sales, you have a cost of sales, gross profit, and then gross margin, and then we normally have selling expense and operating income, depreciation, amortization, interest expense, taxable income, then we pay the taxes, then we have a net income and the net income margin. So why do we have this separately? What is the meaning of gross profit?
Overall profit.
Not overall.
It means, let's say, if I buy something for 100 and sell it for 150,
Yes.
gross profit is 50.
So that's gross profit before making out any administrative or selling expense.
Net is when you subtract like salary.
Subtract other expenses. So when you are subtracting your selling, your so gross, why you want to know gross profit and why you want to know other net profit separately? What is the logic?
Then you can tell your operation costs,
Hmm.
meal overhead.
Operation cost also, and your pricing.
Yes.
Are you pricing your product properly or not? If your net profit is loss, let's say for example, see pricing is means it depends on your customers also, right? How much your customers are willing to pay. If let's say you buy something at $100 and you are selling it in the market, the price is 120, you cannot charge 130 because your expenses are another 20 to pay the traveling or other selling and general expenses, right? So you cannot charge customer 130 because your expenses are high. So what do you mean? It means what do you need to do? Either reduce your purchasing price or control your expenses. That's the only way. Selling price will not be able to increase because of the competition. Unless you are the only one in the market who is selling. If you are the only one in the market, go ahead and increase the price. But if you have other competitors, you will not be able to increase the price unless you add more value. Maybe you want to add something more, make it more nicer, make it more better, make it more easier for consumer to use, add value, then you can charge more, otherwise you cannot charge. Correct? And then the other expenses, to see how much is the percentage of other expenses. So you can compare the businesses, different businesses or different business models with the help of profit and loss statement. How the two different business models are comparing. Somebody may be manufacturing everything by themselves, so they don't need to do a lot of other expenses, right? Maybe they are not, if let's say they are they are manufacturing themselves, they need to have a factory, they need to have a fixed labor cost, they need to have a lot of land tax or other licenses, or otherwise they can go and buy from the market directly. Then they don't need to have a factory, they don't need to have administration, they don't need to have a lot of staff, so they will save, but the cost of buying will be higher. So you can assume two different businesses which are having two different business models. One is buying directly from the market and selling, no administration, no fixed cost. Another business is doing everything by themselves, buying raw material, making the material, and then selling it, and may also have a marketing expense, right? So there are two different models. So you can compare the profit and loss when you are looking. So their gross profit will be different, and net profit may be different, may not be different, right? Maybe if they say totally they are spending the same money, you are doing everything by yourself, but the profit remains the same. So you can judge which model is better for you and when. Okay, you may be in, if you are in a trading business, you can be selling branded products or unbranded products. If you're selling branded products, you may not need a lot of marketing because the marketing is done by a brand. But if you're selling something unbranded, you need marketing, right? A lot of marketing expense. So the segregation between cost of goods sold and the selling and general expenses help you to understand the beneficial benefits or the disadvantages of different business models. Okay. Then the other are interest and depreciation. So we call this operating income. Why we don't include interest in operating income? Any idea? What is the meaning of operating income and net income, taxable income? Now a lot of businesses are putting depreciation as selling general and administration expense. Some business they still separate it up. But that's a different discussion. What I want to put you is operating income. What is the difference and interest expense? Does it make any difference on your business if the money is coming from your pocket or from your father's pocket or from the bank? Does it make any difference on the business performance? No, right?
No.
The business will still run as the same. The money where it come from, it doesn't make any difference. You may have your own money, you may have borrowed money from the bank, you may have borrowed money from your father, which is not interest, right? Or you may have money, you may have borrowed money from a microfinance company which is charging you like 3%, 4% per month. But the ultimate objective is you are putting the money into the business, and for business performance there is no difference where the money is coming from. The business will run it as it is own, right? Correct. So the operating means how does the business perform. So it may have, you may have money on loan, or you may have money of your own on your own. So the operating income will tell you the real business operating performance, not the net income. Net income is only for owners. Operating income is mostly for business. So you may think now, if you are a startup and you have borrowed money from somebody, and somebody else now come and buy your money, buy your business out. If you base your valuations on net income, because you are running business on the interest, your valuations from your perspective are very low, right? Because you are not operating the business. You are making valuation from your own income point of view. But if somebody else who has his own money, he don't need to pay the interest. For him, the income will be more, correct? So immediately the valuation will jump. Okay, so valuation part is the last class, so we will not go into it now. Okay, this is a part of balance sheet, an example of balance sheet. How does a normal balance sheet looks like? So you can see here you have assets, non-long term assets and long term assets. So long term assets means which one you are going to use for more than 1 year. So all the definition of long term is more than 1 year, and you will see there is something called depreciation here. So depreciation means you are charging the value of assets over the life of your assets. So if let's say you have an asset for 3 years, so for example a laptop, how long it's gonna last for? 3 years, maybe 5 years maximum, right? After that it's become obsolete. So if I spend 1000 now, and I'm not charging to this profit and loss account because I'm putting it in my asset. Whatever I define as an asset, it's not going to be charged into profit and loss statement, not as my expense. But I still pay the money, right? I still need to recover this money in 5 years. So what I'm going to do is I will divide the value of this laptop by 5 in each year, and I will charge one portion to the profit and loss every year. Divide by 5. If life is 5 years, if life is 10 years, divide by 10 and charge every year. So that charge is called depreciation. So why do we charge depreciation? To show the profit in equal terms in real life. So if the value is going to be charged for 10 years, we charge 10 years. If this is going to be used for 5 years, we charge in 5 years, equal installments. And also to keep a reserve. If let's say you are a business and you make $1,000 every year, but you need to pay depreciation. You are not paying depreciation, right? You are just making a charge to the profit and loss. After 5 years, you need to replace the asset. So where are you going to get the money from? If you are the owner and you see the whole profit, you will take everything as a dividend, correct? You will take out the money. Oh, I am earning a lot, so let's take out the money in cash. After 5 years, you have no money left to replace the assets because you already finished. You already spent all your money, right? So to keep a reserve of cash so that you can replace your assets in future. So it's like creating a fund slowly to replace the assets in future. So this is very important for a business which is very light, very heavy on assets. If it's a startup which does not have a lot of assets, it doesn't really matter a lot. But if it's a factory building which is depend on assets, it need to build a reserve slowly, so that after a certain point of time, when you need to replace the asset, you have money. If you don't have money, your business will shut down after 10 years, right? Okay. This is the another statement. Normally, so here is you have assets, long-term assets. Non-long-term assets means the asset which are going to be finished in less than 1 year. So if something is less than 1 year, cash, is it gonna last for more than 1 year? No, because you need it tomorrow, right, to spend. In receivables, are you going to not collect the money for more than 1 year from your customers? No, you want money immediately, right? Or within 30 days or 45 days, whatever is your credit period. Inventories or your material, you want to sell as soon as possible, right? You are not going to keep that for more than a year. So that is all non-long-term assets. We call them non-long-term because our intention is not to keep for more than 1 year. Our intention is sell it out. If it doesn't sell, it does not change the definition here, because it depends on our intention. If our intention is that we don't want to sell the inventory for more than a year, then okay, it's moved to non long term assets because you don't want to sell. Okay. Liabilities work the same way. Now long term means whatever you need to pay after 1 year, and non current liability means whatever you need to pay within a year. Owner's equity means what money you bring in and whatever profit you have been earning during the life of your business. So the statement of owner's equity defines, show you the reconciliation. What was your equity at the beginning of the year? How much money you earned? How much money you paid in dividends? And what is the left? What is the balance? Okay. And finally, cash flow. So cash flow is another more important document of any business. So what does cash flow does? It has three, as you can see, three segments. One is cash from your operations, cash from investing, and cash from financing. So cash from operations means your business operations, buying, selling, right? So how much money are you able to make from your normal operations? The cash from investing means how you are using the money. Investing normally will be in negative because you always are investing into the business, right? You always buy some new asset, you always buy new equipments to continue your business. So it will tell you where the money is coming from. The financing can be plus, can be minus. It means if you are taking a loan or you are repaying a loan, or you are buying a new equity share, or selling your existing equity shares. So financing means it can be plus or minus. So how does it look like is whatever you have investing. So in this case, you are investing $115,000. So where this $115,000 come from? If business is investing $115,000, where the money is coming from? If you look at the statement, the money come from some money come from operations, right? 33,000, and the balance come from financing. In financing, what did they do? They are acquiring a new loan, right? 105,000, and they repay some short-term loan and dividends, correct? So means this is how they are using. So, but primarily they took a loan to buy a new asset. Some of the money come from their operations. So this statement will give you a snapshot of the company's overall performance in one single page. How much money is it, the money is able to, is it the company is able to make money or not? Is it, how does the company is spending its money? Is it investing enough or not? So what is more important here? Cash from operations. So if let's say you have a negative cash from operations, means you are not earning enough. Is it good or bad? It's actually very, very bad. So means if it's minus, what does it mean? You have no money to invest, correct? And where the money come from? Borrowing, right? Otherwise the balance will be zero, and cash cannot be negative, as we said earlier, right? So if you are losing money from your operations, where the money will come from? The money will come from borrowing. So which is not a good idea for a business. You cannot run a business successfully for a very long period of time only with the borrowing, or only by raising the money from investors, correct? So means issuing the share capital. That is not a long-term strategy. So if normally the investor or anybody who is investing the money to the business, they will look at the cash flow statement for last through 3 to 5 years and see what is the trend. Is it the company being able to generate cash from operations or not? If company is able to generate the cash from their operations, it's okay. They may invest the money. But if you are not able to generate the cash from your operations, it's going to be very, very difficult to project that the company will survive for another 3 years, 5 years or not. Because whatever money they have been giving, you are losing in operations, right? Okay, so that is cash flow statement. So these are the 4 statements. 3 of them are very important. So what are the important ones now? What are the three financial statements we learned? First is, the first is profit and loss statement. So what profit and loss statement tells you? Your income and your expenses. The second is balance sheet. So what does balance sheet tell? Your assets and your liabilities. And the third statement is cash flow. So what does cash flow tell? Where the money is coming from and how you are spending the money. So profit and loss will not be able to tell you where the money is come from. It will just tell you how much did you earn and how you spent. But it doesn't give you the assets, your investment, right? Or where the money is coming from if you are making a loss. Cash flow is telling you both the story. So cash flow, you can say, is a summary of your balance sheet and your profit and loss statement. So if you are not able to get profit and loss statement or the balance sheet, it's okay. So far as you understand the cash flow, that is the main document. You may be making a lot of income. What if you are not collecting it in cash? Maybe you are making a lot of sale. But what if your customers are not paying you? Correct? So what will be happen to your cash from operations? It will be positive or negative? If you have lot of sales which you are not collecting the money, which you are not able to collect, so your cash from operations will become negative, right? Because you don't have enough money in actual terms. Your profit and loss will show you have a lot of income, right? But in actual cash you may not have it. So the cash flow is like a real life document. You cannot lie in cash flow because it's related with the cash, actual cash. As I said, if you are not printing the money, it's okay. Then the cash flow will tell you where you are hiding, and you can how you are hiding the money, right? So the accounting process, to summarize, start from writing the journal book, coming to the journal ledger, then go to the trial balance, and trial balance is divided into income statement, balance sheet, and owner's equity. Cash flow is generated by these 2 documents together. Okay, so cash means whatever income you have earned, whatever expenses you have earned, the balance sheet will tell, are we able to collect the money from our suppliers or not? Are we collecting the money from our customers? Are we paying to our suppliers or not? Okay, so this is the summary accounting process. Now the next thing is before how we do the classification. Okay, you have recorded the journal, but and you learn that we have to make the general ledgers, correct? And so, but how you will know which account will go to profit and loss, which account will go to balance sheet, and which account, what are the revenue and expenses. So we normally categorize our accounts into two parts. One is position performance account and one is position account. So performance accounts means our revenues and our expenses. They show our performance. How much money we earn, how much money we spend, performance. Then we have position accounts. They will tell you your exact current position. How much money you owe, how much money you own. Means what is the total value of your assets. So most are asset and liability. So we divide all the category, all the accounts in these four categories. One is performance, revenue, expenses, and your position, assets and liabilities and equity. Okay. On the very major difference between these two is this expense will finish at the end of the year. Means if whatever you accumulate, it will not carry over to the next. If you have made a sale of 100,000 this year, when you next year you start the sale account, the counter will set to 0. Means you will always start with 1. So where this 100,000 will go? Sale will go to profit and loss, right? And profit and loss, whatever is the balance will go to balance sheet. So it means this $100,000 will ultimately go to the balance sheet within the same year. And balance sheet means your position account are not reset. So if you have a total asset of 100,000 this year, next year when you start, you will start from 100,000. If you buy another, it will be on extra from 100,000 on top of 100,000, not 0. Sales and expenses will start at 0 every year. Every month, if you are, let's say, closing every monthly statement, every month it's 0, start at 0. If you are setting off your financial statements quarterly, it will start at 0 every year, every quarter. Every year it will start at 0. So performance accounts will always reset at 0, and performance account will position account will continue from where they were previous year. Okay. And performance account at the end, finally the balance of all the performance account in the form of profit and loss statement will go to balance sheet, owner's equity. Okay. Remember the first accounting equation we did, extended accounting equation we did. Owner's equity is part of your original capital plus whatever you retain from your income statements. Okay. So here is an example. So trial balance will go into 4 parts. One is your assets, your liabilities, your revenue, and your expenses. The revenue and expenses ultimately will at the end of the year will go to equity. So finally at the end of the year we will have only two things, either assets or liabilities plus equity. That's it. And that will continue to the next year from not from 0, from where we left off. Okay. So these are some examples. So you need to classify which one is performance, which one is position. So what is revenue? Performance or position? Performance. Dividends? How many say performance? How many say position? It is performance. Receivable? No. Position. Receivables means we are telling you, you don't do like a guessing, no, that either 0 or 1. Receivable means it will tell you how much money you need to receive. So it's not your income or expense, it's your asset. So it's a position account. Long-term assets? Position. Interest income? Performance. Additional paid in capital is position, because the paid in capital will stay there, right? Common stock? position. Interest paid,
Performance.
performance. Cash,
Performance.
huh? Cash.
Absolutely.
Cash is your position account. Advertising,
Performance.
performance. Tax payable,
Position.
position. Office supplies,
Performance.
yeah, office supplies you can say either because this one is not very clear. Office supplies you can have a performance account or you can have a position account. Depends on your policy. If you put this as an inventory, it will become your position account. If you charge immediately, it will go as a performance account. Rent, performance. Inventory,
Position.
position. Suppliers,
Position.
position account. Yes. So these are the four categories that we discussed earlier. Assets are long term assets, cash, inventory, receivables. These are position account. Liabilities, common stock, dividends, supplier, additional paid in capital, tax payable is all position accounts. Then you have revenue and expenses. So these are your performance accounts. So performance accounts will go at the end of the year, we will merge them together and put into common stock as a owner's equity. So becomes a position account at the end of the year. Okay. Okay. There are certain transactions which companies does with outside people's external, right? Most of the transactions are external because you have to have a third party to do the transaction. You are hiring a staff is also external because from company perspective, who is the company? Is the owners, right? So owners, unless they are, even the owners, physical owners are separate from the company. Normally companies are like a legal entity, separate from their own entity, right? From their owner's entity is different. Staff is different, third party. All are third party for the company. So most of the transaction happen between two parties, one from company and external. So it can be your customers, your suppliers, your clients, lenders, shareholders, because it's easy to see what is coming in, what is going out, correct? Because we are either getting services or giving services, either giving cash or getting cash, right? But there are certain transactions which happen within the company where the third party is not involved. So what are those transactions? Nothing is coming in, nothing is going out, but we still have to record a transaction. We just discussed one such transaction in the form of depreciation. Is it a depreciation is external transaction or internal transaction? Is anything going out when you charge a depreciation? Nothing goes out, right? Because you bought an asset, but that was another transaction. Now you are charging the depreciation into 3 years, 5 year different years. So that's not a different, that's not an external transaction. Nothing is going out, nothing is coming in, but it is still a transaction. Correct? So there are certain transactions where nothing goes out, nothing comes in, but these are transactions within the company. So special transactions. Okay, only few transactions there are, not many. Depreciation, it's an internal transaction. So how it happens is it hit two places. One is your profit and loss statement in the form of depreciation, and another way is it hits your balance sheet in the form of reducing the value of your asset. Whenever you are charging the depreciation, it reduces the value of your asset. So if the value, if the balance, if your asset was for 5 years and you charge 1 year depreciation, next year it remain only 4 years, right? Value will be reduced from 5,000 to 4,000. Another 1 year pass, the value reduced from 4,000 to 3. Another year pass 2. Another year pass 1. Next year, no. Zero value. So then in the 6th year, there is no depreciation charge because the value is already finished. Correct?
But is there like a standard for, let's say, if a company buys a car,
Yes.
is there like a depreciation percentage
Hmm.
with yourself, right?
Yeah, normally every country has their own depreciation policy. Company can have their own depreciation policy. So depreciation, because the tax is like a subjective matter, right? The government, if you, let's say you want to charge, you said the life of this asset is only 5 years. Let's say you buy a Mercedes tomorrow and you tell the government, because depreciation you can deduct from your taxable income, correct? So you can say now the Mercedes is only 5 year life. Nobody will believe that, correct? But you can claim because you are the owner of the company, you are owner of the Mercedes. So let's say the Mercedes cost you $1 million. So now in 5 years, you're gonna charge how much? 1 year. 1 million divided by 5
200.
is $200,000, right? 200,000 you will charge to profit and loss statement every year, and you submit to the tax department and say, okay, my total income is 200,000, and here is 200,000 depreciation. I earn nothing, zero. So I don't pay any tax. But government don't accept your 5 year policy because they think Mercedes can go as long as 10 years easily, right? What does that mean now? For government, what is your tax? What is your depreciation?
And it's gonna be 100.
100,000, right? Now your income remains the same, 200. 200 divided by minus 100,000. So you still have 100,000 balance, right? So you need to pay tax from government perspective. From your perspective, you don't need to pay anything. So there are policies, standard depreciation policy which government follows to make sure you are not cheating with the tax. So they will not allow you. You can, in your books of account you can do whatever you want, but for when you are submitting the tax, you have to follow government rules. So government has a standard normally all around the world. Most of the time, they have a standard depreciation of 5 years for something like office equipments, chair, table, car. For transportation equipments, car, truck, bus, they follow around 10 to 15 years. It depends between the country. In Europe, it's longer because their life are longer. In Asia, it's shorter because the roads are not very good. So the car will get damaged very fast, right? And also it depends on how you use it. If you are using it like as a taxi, so your car will go off very fast. But if you are using it for your for your personal use, you are not using the car that much, right? You may be using it once in the morning, once in the afternoon, once maybe go for a meeting inside. But taxi is all around, right? So the engine will go very fast. So it depends on how you use the asset. So depreciation is very subjective policy. So governments normally want to control. They will not allow your creativity in depreciation because it affects the tax calculations. So you need to follow government regulation when you are submitting the tax. But for your own books of account, you are free to do whatever you want to do. It's your books of account, right? So we have a very small topic to explain how the depreciation policy makes an impact on your books of accounts. Okay,
What's the policy here?
where in here I think the cars normally they allow 10 years minimum. Means you want to use 15 years as a depreciation, they will allow, but minimum is 10. They prescribe minimum years. For example, like building which is made by concrete, they say minimum 40 years.
40 years.
Yeah, minimum. You want to charge 80 years, go ahead. But the longer year, the longer life you assume, the lower depreciation you charge, the higher tax you pay. But you can use it for longer period of time. So it depends on the policy that you adopt. But government they have a fixed formula for allowing you the depreciation. You have to follow them. You have no choice. There was a company nowadays, especially now, the revenue department is very strict with the depreciation policy of the companies. They find one company, I will not name the company, they find them nearly $1 million for cheating on the tax rates. They did not follow the government tax rates. So when the revenue department come for auditing, they found the tax rates are very high, and they follow the exact same tax rate as per government, and they fine them nearly $1 million as a penalty, and the company has to pay now
Like
on
all
tax,
in one.
all in one. So whatever you have saved in the past, you are paying now. Okay. Okay, so the depreciation accounting is pretty clear. I think we don't need to go into the too many details. So the other internal transactions called accruals means making an accrual for for your unpaid liabilities. So maybe you have a salary to pay, right? But you have not paid in cash yet. So you still need to record the liability as your expense and as your liability. So why we record accruals is because we want to, if let's say you are doing monthly accounting, so if this month's salary you didn't pay, you still have to record your expense because you already you already accrue the expense. It just doesn't matter that you pay or you didn't pay, right? You need to record expenses when in which month they happen, not when you actually pay them. Then the provisions also the same way. The difference between accrual and provision is accruals means the transaction has already happened. You already consume the electricity bill, you already got the bill, you already consume the salary, you already have it, but you have not paid for it. Provision means you may have a liability in the future, you may not have it. For example, staff retirement. So if let's say all of you are my employees and you're gonna retire at the 60, so do I have to wait for 60 years to pay you the retirement fund? At that time I may go bankrupt if I don't charge your cost now, right? And if I don't charge your cost now in this period that you are working this year, but I'm not charging anything for your retirement benefits in this year. So I don't want to hit my profit and loss after 60 years. So what I will do is I will build up the provision every year for 60 years. And at the end of 60 year, when I need to pay the money, I will use that provision and pay the retirement fund. So in that way, I don't hit my profit and loss statement in 1 year, rather for 60 years of accumulation, correct? So that's how the provision works mostly. Then you have adjustments and write-off. So adjustment write-off means, let's say you have a customer who was supposed to pay you 1,000 and now is go bankrupt. He pay you 500 as full and final settlement. So what will happen with the 500? The balance 500.
You,
Write-off.
right.
So that is we call write-off. We charge that to profit and loss. It's your loss, right? You lost the value. So you charge that loss to profit and loss statement and say I lost $500 because of somebody go bankrupt. So that is called write-off. So that is also an internal transaction. There is nothing going out, nothing coming in, right? So it's called internal transaction. So this transaction is also important for most of the businesses. You have to review your accounts receivable, customers who were supposed to pay you money, your inventories. Sometimes the inventory, let's say you buy a register for with your company logo and you put into your inventories. Next year you change the logo. So now you cannot use the previous one anymore, right? So what will happen to the value?
Zero.
Zero, right? So but you still carry that value in your inventories. So what will happen? If you don't charge off, means you say that okay, I lost this value and you don't charge to the profit and loss statement, that value will continue in your inventory for a long period of time, even though you know it's not valuable anymore, right? So that is called adjustments and write-off. Whatever you lose because of bankruptcy, because of the change in the company policies, change in the design, change in the value, you are losing assets or you are losing your rights which you previously recognized as income or as paid for, right? So that is called adjustment and write off. So most of the companies they don't do it because they don't know, but they should do. Every year we have to adjust our inventories to see is it still worthwhile to keep or not. Okay, so there is an exercise, small exercise. Now it's 4 o'clock. Okay, we still have time. So what I want you to do is I want you to record the journal.